Hey everyone, and welcome to The Explainer. Today we're diving into a concept that is literally making us rethink something we use every single day: money. We're talking about a currency that's trusted by millions around the globe, yet it completely bypasses the traditional banks we've relied on for centuries. It's an incredible leap in technology, and honestly, the architecture behind it is just fascinating. Let's get right into it. Just imagine money controlled by absolutely no one. I mean it. No government manages it, no central bank owns it, and no private company prints it. It is a fully decentralized financial system. For our entire lives, we've implicitly trusted central authorities to manage our cash and our credit cards, right? But this system asks us to imagine a world where that central authority just doesn't exist. And that brings us to the core subject of our explainer today. Some people are calling it the future of money. Others call it digital gold. You've got skeptics calling it a total bubble, while advocates believe it could completely overhaul the global financial system. But before we can even begin to figure out who's right in that debate, we have to start at the foundation. We really need to ask, what exactly is Bitcoin?
Part 1. The birth of Bitcoin.
To really grasp what Bitcoin is, we have to rewind to a very specific moment in time, the year 2008. It was a time of massive financial turmoil. The global financial crisis saw major institutions failing and stock markets absolutely crashing. Everyday people lost a huge amount of trust in traditional banking. And right in the middle of this chaos, in October 2008, someone, or maybe even a brilliant group of people, using the completely anonymous name Satoshi Nakamoto, published a white paper. This document outlined a totally new kind of electronic cash system. And get this, to this day, the true identity of Satoshi Nakamoto remains a complete mystery. Nobody knows who it is, but the idea spread like wildfire, and in January 2009, the Bitcoin network officially launched with the creation of the very first block of transactions, famously known as the Genesis block.
So, Satoshi Nakamoto successfully created this system that didn't rely on central banks to keep track of who owns what. But how is that mathematically and technologically possible? It all comes down to the underlying tech. Which leads us to our next crucial question. But what exactly is a blockchain? Part 2. The blockchain explained. Fundamentally, a blockchain is a shared digital record, but it's not maintained by one server locked away in a bank's basement. Instead, it's maintained by thousands of computers scattered all around the world. As transactions happen, they're verified and grouped together into blocks. Each new block is then securely linked to the previous one, creating a continuous, unbreakable chain, hence the name blockchain. Because thousands of computers are maintaining it together, attempting to go back and alter past records is, well, extremely difficult. That's what makes the system incredibly secure. To put it into perspective, think of a traditional bank as a single, locked notebook. Every transaction is written on a page, but only one authority, the bank, holds the pen and the key to the vault. We just have to trust them. The blockchain, on the other hand, is like having millions of identical shared notebooks, distributed globally. Whenever a new transaction happens, all of those millions of notebooks update their copies together, simultaneously. No single person owns the network. Now, this shared notebook system sounds incredibly secure in theory, but theory is one thing and everyday use is another. If I want to pay a friend for dinner using this decentralized network, what actually happens behind the scenes? How do you actually send it?
Part 3. The mechanics of a transaction.
Let's break it down. Step 1. You initiate the transfer using your digital wallet. Step 2. That transaction doesn't go to a bank. Instead, it gets broadcast out to the entire Bitcoin network. Step 3. This is where the magic happens. The computers on the network, often called miners, go to work to verify that you actually own the Bitcoin you're trying to send. Step 4. Once verified, your transaction is grouped together with other recent transactions into a block. And finally, Step 5. That block is officially added to the blockchain. Once it's confirmed, boom, your friend receives the Bitcoin. The whole shebang relies entirely on decentralized consensus. So the system functions seamlessly to transfer value. But, with traditional money, when economies struggle, governments can simply decide to print more cash. If Bitcoin is just digital software, what's stopping someone from just hitting copy and paste on the code? Why can't people just make more? Part 4. Digital scarcity. 21 million. That's it. That is the absolute maximum supply of Bitcoin that will ever exist. Bitcoin's original software actually has a hard-coded rule that strictly limits the total supply to exactly 21 million coins. Unlike fiat currencies like the dollar or the euro, there's no central authority, no developer, and no miner that can simply decide to print or create more out of thin air. Now, this fixed supply is a radical departure from how we've managed economies for decades. Supporters of Bitcoin argue that this strict digital scarcity is exactly what gives it value and protects it from inflation, making it totally unique. However, critics heavily debate whether a currency that cannot expand or contract based on economic needs can actually serve as a highly functional form of everyday money. We aren't taking sides here, but it is absolutely crucial to understand that this 21 million cap is the heart of the economic debate surrounding Bitcoin, which naturally brings an obvious contradiction to mind. If the supply is so perfectly fixed and predictable, why does the value of Bitcoin seem to jump wildly up and down every other week? If it's limited, why does the price change so much?
Part 5. Volatility and global markets.
Well, because the supply is fixed, the price is almost entirely driven by fluctuations in demand. If more people want to buy than sell, the price goes up. If more want to sell than buy, it falls. But demand can shift wildly. A positive news story, a harsh new regulation, or the sudden entry of large institutional investors moving millions of dollars around can change public perception overnight. Technology developments and just general market sentiment all influence how much people desire Bitcoin at any given moment. This wild cocktail of unpredictable factors is exactly why Bitcoin experiences such significant price volatility. It's a major consideration for anyone thinking about using or holding it. You'll actually often hear people say that Bitcoin controls the broader market, but that's only partially true. Because Bitcoin is one of the largest cryptocurrencies, its massive price movements do often pull the broader crypto market in the exact same direction. When Bitcoin jumps, other digital coins usually follow. However, it definitely does not control the entire global financial market. Traditional asset classes, things like stocks, bonds, and government currencies, are still driven by a vast array of additional complex economic factors that have absolutely nothing to do with Bitcoin. So we've seen how it works, why it's scarce, and why it's so volatile. But when we zoom out from the daily price charts and all the market hype, we really have to evaluate the long-term impact. What does this all actually mean for the future?
Part 6. The legacy of decentralized money.
At the end of the day, Bitcoin's true innovation was proving that we can, in fact, transfer value across the internet using a decentralized network rather than relying on a single central authority. It showed the world that a distributed ledger, the blockchain, actually works in practice. Now, whether Bitcoin becomes the dominant part of our future financial system, that remains totally uncertain. But its foundational impact on technology, on finance, and on how we even discuss the very nature of money has already been profound and permanent.
Before we wrap up today, just a very quick, important note. This explainer is created strictly for educational purposes to help you understand the source material. It is not financial or investment advice. As we've discussed, cryptocurrencies, including Bitcoin, are highly volatile and involve significant risk. You should always do your own research, understand those risks, and consider consulting a qualified financial professional before making any investment decisions.
So Bitcoin cracked the code on creating decentralized digital money. It proved the blockchain works. But once that door was opened, technologists realized this shared notebook could be used for far more than just sending digital coins back and forth. Which leaves us with a fascinating question to ponder. Bitcoin created digital money, but what is Ethereum? And why is it being called the world's decentralized computer? That is a brilliant evolution of the blockchain, and it's exactly what we will explore next time. Thanks for learning with the explainer.